often when I see investor sentiment decline from optimistic levels, I take that as a pretty good thing.
Generally speaking, when you look at historical patterns, when sentiment is the worst, it's actually a great time to buy. And we would view that as a good opportunity today to reinvest in asset classes that have been underloved over the last 6 months.
Like?
So what you've seen this year, I was just alluded to earlier, is emerging market sell-off, particularly China. It's been a huge dislocation driven not by necessarily fundamentals, but more so sentiment and concerns over trade policies between Beijing and Washington. Now, we don't pertain to know whether or not we're going to go into a full-fledged trade war. We don't really believe that the White House even knows whether or not we're going to kind of ramp things up further as we kind of go out through the summer. But investors are clearly worried about that. And so from our perspective, you need to take a longer-term view and really find the distinct opportunities in the asset classes amongst emerging markets, as well as U.S. equities that can take advantage of some of that near-term volatility.
Lisa, how do you feel about the U.S. market here? I mean, would you rate it a buy, a sell, or a hold?
We're actually neutral on the U.S. equity market right now. And as Grant points out, part of the reason for that is on the positive side, actually the fundamentals look okay. So if you look at the top-down indicators, for example, a number of concurrent and also leading economic indicators, what you actually see is 2/3 are in positive territory. In addition to that, when you look at the bottom up, corporate earnings are still very good. So they're expected to come in at 8% for the second quarter, as well as 20% year over year for 2018. So overall, the fundamentals are good. The reason we're more at a neutral stance, however, is because there's a number of factors on the other side of the scale. You do have a number of geopolitical risks that are causing the levels of uncertainty to go up. Valuations are slightly elevated right now on trailing 12 earnings. They're somewhere around 21 times. In addition, you do have technicals that need some repair. So we see the scale is fairly balanced right now.
So, Grant, Lisa is a little alarmed by valuations. I take it you are, if not alarmed by valuations, you're a little heartened because the P's have come down, the E's have come up.
The growth in earnings this year in the U.S. market has been phenomenal. Surpassed.
So you're more comfortable with valuations now than you were, say.
You know, I think it's one of those things where if you looked at 6 months ago, people were concerned about the multiple for the S&P. That's come down to 16.5 times roughly forward earnings. We continue to believe that earnings are going to do very well here in the United States, led by technology, which is a big overweight for our portfolios at the moment. And then if you look more globally, particularly within the emerging markets, the valuations are actually very cheap. And so from our perspective, there's a lot of opportunity to take advantage of some of the near-term volatility.
Isn't there a reason for the cheapness in the emerging markets? Rates are going up. The dollar is stronger.
Sure, I think
it doesn't help.
Generally very bad things.
So the reason I think it's bad if rates move up from a shock perspective. If it's the continued gradualization and normalization of interest like we've seen for the last 2 years, that means that the backdrop for the economic environment is actually quite good, and so that generally is good for emerging markets. We don't see a repeat of the taper tantrum like we saw in 2013. We still very long-term outperformance for emerging markets based upon some secular growth opportunities.
Lisa, since you're neutral in the U.S., would you go outside like Grant has suggested?
Well, we're actually neutral across the board on equities right now, which is actually a little bit of an unusual stance. We usually have more over and under weightings. But the reason why is if you look across the board, while generally fundamentals are still hanging in there, you do have a similar valuation situation overseas. Again, it's not elevated, it's not priced to perfection, but they are somewhat above median areas. And in addition, you're seeing a little bit of a slowdown on the fundamental side. And again, worldwide, we have some technicals that need repair. So we're neutral overall and really looking for opportunities to exit and re-enter some asset classes as pricing continues to develop.
So maybe you just answered it, but very quickly, Lisa, what does neutral mean in practice for an individual investor who's listening and going, she's neutral? What does that mean I should do?
Absolutely. So we're advising our clients to stay pat with their strategic asset allocations. So to neutral relative to those, and then wait for those tactical opportunities to appear.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.